Hello, everybody. Welcome to this webinar that is brought to you by Bursa Malaysia and managed by our company LifeChamp. So today, I am very excited to be doing this session for you, which is titled Fibonacci Analysis for Trading. As you know, Fibonacci is one of very important technical indicators or technical tools that's in technical analysis studies. So today, we're going to study how to use this golden ratio, golden number, okay, Fibonacci, to spot trading opportunities. Okay, so we have a very accomplished technical teachers here today, who is Pauline Young, who will guide us through how to do Fibonacci analysis for trading. So without further ado, as usual, disclaimer: whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation to buy or sell any companies should we do any case studies in this webinar. So if you decide to make any investment decision, you are 100% responsible for your own investment risk. Now, allow me to briefly introduce our speaker today, and she is none other than Pauline. So Pauline is a licensed and experienced financial planner who is certified by the Malaysian Securities Commission Financial Planner Representative License and Bank Negara Financial Advisor Representative License. Pauline is also a course trainer and public speaker at Financial Planning Association Malaysia and Bursa Malaysia. Over 25 years in education, she has accumulated over 50,000 students and conducted over 200 large-scale corporate courses. So other than being a professional financial planner and educator, Pauline is also a best-selling author who has published 6 books on investment and financial planning. So her articles have appeared in financial magazines such as The Personal Money, Money Compass, and many more. So this is Pauline. To write one book is already very hard enough. So she has written 6 books, and you can still get her books at the major bookstore. All right. So without further ado, let me just bring forth Pauline. Pauline, how are you?
Hello, hi. Good evening, Shane. Good evening, everyone.
Good to have you back on our Bursa webinar.
Yeah, thank you.
So let me hand over the session to you.
Okay, sure. Okay, let me share my screen. Okay, so everyone can see this, right? All right.
Yes.
Okay, so hello everyone. My name is Pauline Yong, and I'm a licensed financial planner, and I'm also a certified chartist. So today we are going to talk about Fibonacci analysis for trading. Although the word is for trading, but in fact, Fibonacci can be applied to investment as well. So as long as you are looking at whether either investing or trading, we can also apply Fibonacci. Okay. Hi, I see that a lot of people are here in the session. So good evening. All right, so let me talk about the agenda for today. So we're going to look at the origin of Fibonacci and learn about the key Fibonacci ratios in trading and the 3 simple Fibonacci strategies, which is the pullback, the breakout trade, and trading with us indicators. And also at the end of it, we learn about the risk management, money management, because when we use Fibonacci as a tool, we also need to know where is your target and where is your cut loss. Okay, so that will be the objective for today. So I hope in today's session, everyone will learn something and you can apply straight away. Okay, I promise you definitely can apply straight away. Okay, so when we talk about Fibonacci, we are looking at technical analysis. And when I just started out long time ago in 1997 as a research analyst, my background was purely fundamental analysis. I have no background in technical analysis at all. So then what makes me want to learn about technical analysis? And that was because the year that I joined, it was 1997, and that was the year of the Asian financial crisis. So that Asian financial crisis was like something very shocking to me in my life, because as a beginner, so that was the first thing that hit in my career. So, but nevertheless, I noticed that, okay, I observed that fundamental analysis, although you learn about the economic data, you learn about the fundamental of the company and everything, But to a certain extent, if you want to predict the bottom or the reversal, you still need to rely on the technical analysis. And since then, I started to pick up technical analysis. And then now every day, every single day, I'm looking at charts. Every single day, I'm looking at charts. So although I do look at the fundamental, but then the chart is a part whereby you will have to identify the entry and the exit. Okay, so the timing of buying and selling. And this Fibonacci is something that I apply, and but I will teach you the simple way. Okay, very, very simple. Don't worry. So let's start. So the origin and the history of Fibonacci, in fact, is long time ago. So actually was introduced by this person. His name is Leonardo Pisa, aka Fibonacci. So it's named after him. And this is 13th century. Okay, so that was long time ago. And surprisingly, the numbers, right? He noticed that there is some number sequence that appear in the nature, and it happened throughout the whole universe. So from the plants to the animals to the human, it's like everywhere, even to the building. So there seems to be this very mysterious numbers, Fibonacci sequence numbers, that is happening throughout the whole universe. So for example, we are looking at the 1/3 ratio. So if you look at a person 1/3 ratio, meaning that the upper body and the leg has to be 1/3, then it is proportional. Okay, so and if you look at building, the building, you want to see that you must have a certain top, which is about 1/3, and then the 2/3 will be the body of the building. And same as animals like fish. Okay, let me draw a fish. Let me plug my pen in. So for example, you see a fish. Okay, let me draw. And this fish, okay, I have to use my pen again. Okay, this is the fish and the tail, and the body here is about 1/3 of the whole body. So then this is like a normal fish. Okay, so if let's say you draw a fish like this, and then half of it is like a very weird. Okay, so this is 1/3, 2/3 kind of a golden ratio. And let's see how do you get the numbers. Okay, so the Fibonacci sequence is derived from the Fibonacci numbers. The Fibonacci numbers are as follows. So it starts with 0, and then the second number is 1. So 0 plus 1 will be the third number. Okay, so then these two numbers add together, the 1 plus 1 is equal to 2, and then 1 plus 2 is equal to 3. So whenever you want to get this number, right, you have to add the first two numbers in front of you. So this 5 is derived from 3 plus 2. And then the 8 is derived from 5 plus 3. So then you have this sequence. So it's 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and then 89, and 144, and so on. So all these are based on the Fibonacci number, whereby you add your front in front of you, the front two number in front of you, okay, and then become the number that you are looking at. So, and for example, in the stock market, if you look at certain price, so sometimes you see that this 1 ringgit, 2 ringgit, 3 ringgit, 5 ringgit, 8 ringgit, these are the common psychology price level. And for many years, right, you notice that Nestle, okay, if you can remember a few years ago, Nestle for many years, it was hovering around 144 for a long time. Okay, so that's interesting. And 21, okay, 21 is something that some people, they may want to use the moving average as 21. They may like to use 13-day, 21-day, 8 days, this kind of a Fibonacci numbers for their moving average. And yeah, so these are all psychology and then numbers, and then it also affect the stock market because these are all psychological numbers that investors are looking at it. Okay, sometimes you look at the number, is like you find it familiar, so then you react to it. For example, 2 ringgit. 2 ringgit is like a resistance. So whenever you are at in 1 something, 1 to 150, and then from 150 to 160, 170, 180, when it comes to 190, then seems that this 2 ringgit is a resistance level, and then it will take some difficulty, challenges for you to pass over that 2 ringgit hurdle. So all these are psychological numbers. Okay. Then let's talk about the ratio. How do we come up with all these golden ratio? So very simple. You look at these numbers again. You use the front number divided by the back number. So 2 divided by 3. And this will give you, okay, use a calculator. 2 divided by 3 will give you 0.666. All right. Then you use that 3 divided by 5. 3 divided by 5, it will give you 0.6. And then 5 divided by 8, it will give you 0.625. All in the 0.6 region, okay? And then 8 divided by 13, it will give you 0.615. So the number is more or less around there, but it's between 0.6 to 0.6666, okay? So it's around there. So in this, if you to add more and more numbers together, 55 divided by 89, then you get closer to 0.618. And then the larger the number that you divide, it will become 0.618, 0.618, 0.618, and 0.618. So this 618 become a Fibonacci number. Okay, and I'm sure some of you who have who work in a securities firm, and then you see some of the reminder, they have their Gmail account in 618, or their car number, license number, car number is 618. So whenever I see on the road there is somebody's driving on the car and then the car number is 618, I know that that person probably is a reminder or working in a securities firm. Okay, so this 618 is a Fibonacci number. Okay, then when you use the back number to divide by the front number, so what do we get? Okay, so let's see. So just now we use the front number divided by the back number, right? Then we get 2/3 of a ratio. So now we use the back number divided by the front number. Okay, so 13 divided by 8 will give you 1.625. So let's see, this 34 divided by 21, 34 divided by 21 will give you 1.618, okay, 1.619, okay, so which is very close. So 89 divided by 55, and this will give you 1.618. And then the rest of it will give you 1.618, 1.618, and 1.618. So whenever you use the back number divided by front number, it will give you more or less 1.618. So this 1.618 will be also the Fibonacci number as well. And this 1.618 will be looking at that projection. Okay, so looking at the price increase times 1.618 ratio times, and then that will be projected to the next level. Okay, so all these are the Fibonacci number that we will look into it later. Okay, so I just want to tell you about the origin first. So this 0.618 will be known as a golden ratio. Okay, so these are all the plants that if you were to count, I have never count before, but according to the theory, it says that if you were to count all these leaves, petals, and all the leaves, it will be one of these Fibonacci numbers. Okay, so if you are free, you can do that. Okay, so let's go on to the Fibonacci at trading. So the biggest application, okay, for Fibonacci is looking at the retracement. Now, for example, you look at the US stock market. Okay, US stock market on Monday, it fall a few hundred points. And then on Tuesday, in fact, on Monday, it was a gap down. Okay, gap down, and then it was a big drop. now can see. Oh, I see. Okay. So now US market had a gap down on Monday and then dropped a few hundred points, and then the subsequent days, today is a Friday, right? So subsequent day, you see that there was a strong rebound. Now, usually on the first day of the drop, right? A lot of people ask me, oh, how's the stock market? How would it be? And then, like I'm like a forecaster, but I'm not a forecaster. I can't predict. But from the technical analysis, I can do some form of a certain degree of a prediction, okay, but not as accurate as it is, because nothing is 100%. But based on the technical analysis, you can do certain forecasting. So buy at the dip. Okay. So when we saw this down US stock market fall on the Monday, right? Then I will have to tell the people that we need to observe the rebounds. Okay, so the rebounds is super important, very important. So whenever you have a uptrend and then you have a crash, right? So this crash is, it's nothing, but the rebound is significant. Okay, the crash, you can crash like this. Okay, you can crash like this, you can crash like this, but the rebound is very significant. So for example, you have a small crash and then your rebound is very weak, and then you have a medium crash and then your rebound is like this, and then you have a big crash and then your rebound is like that. Okay, A, B, C, which one is weak? A, B, C, type in the chat box. Which one is weak? How come everybody is so clever? All of you say A. Very good. Okay, good. So that means you guys got a certain standard. Okay, good. So you're right. Okay, so that means whenever there is a fall, you want to see the rebounds. So you can see that the rebound is very weak. So most likely you can imagine that the subsequent one, it will be correct, another downfall. Okay. However, when you see such a big rebound, right, then the subsequent fall will be like this, and then it will be like this, and then in the end, you'll be all the way up. You read the physics. Yeah. So in fact, technical analysis is pretty much as physics. Okay. I always like to link this the technical analysis and the physics together. So you are looking at the rebounds and how much is the strength. What is the strength? So then I observed that this week, the US stock market also have a rebound. Okay, so you need to observe subsequently after the rebounds, and then how strong or how weak is the rebounds. And after that, after the rebounds, you will have a continuation, right? So this fall, right? So, and I want to see how bad is this fall. Okay, usually, okay, I wouldn't say for sure. What I'm looking at is that Monday this week we had a fall, right? And then the Tuesday, Wednesday, Thursday, we are looking at the rebounds, right? And then when we come to next week, we have another double bottom, W. Okay, it will form a W. So we need to see this fall, whether it will pass this low or not. Okay, so that is next week, next Tuesday, or next Monday or next Tuesday. Okay, so we want to see. So we want to see whether this fall here, after this uptrend, you will have a correction, right? So this fall here, will it be supported by the previous low? So if it's supported by the previous low, congratulations. I think we should be looking at a W, and then we should be looking at recovery. Okay, if it's like that. Okay, but if it is if this low cannot sustain, then it will be another story. Okay, so then how does this Fibonacci come about? So the Fibonacci come about whereby you are measuring the retracement. Okay, whenever you are looking at an uptrend, you have a retracement, right? So this retracement. Okay, so whenever you have a downtrend, you have a retracement, and this retracement will be a rally, like a temporary small rally. So this retracement here, you want to see how big is the, or how strong is the retracement, and that you look at the Fibonacci. So Fibonacci ratio will be looking at, later I will show you, okay, will be the 1/3, 2/3, half, or whatever ratio. Okay, so it will tell you the strength of it. So this is exactly what we are looking at, the retracement here, the retracement here. Okay, so again, repeat. So when you are in a bull trend, okay, when you are in the uptrend, the retracement will be the opposite direction, which is this downtrend. All right, so you want to see this downtrend, where is the bottom, the downtrend. So it will be a Fibonacci number that will give you an indication of the strength of the retracement. See whether it will be retraced by 50%, or it will be retraced by only 1/3, or it will be retraced by 2/3. Okay, so here we'll be looking at the Fibonacci retracement. So similarly, in the downtrend, okay, in a downtrend, when you are looking at the downtrend, then the retracement will be that rally, the short-term rally. So you have a longer downfall, and then followed by a short-term rise, and then followed by a longer downfall, and then followed by a short-term rise. So this short-term rise, how deep is the retracement? Is it 50% of the original, or just 1/3 of the original trend? Okay, so you are looking at this retracement of the original trend here. Okay, so this is when you are dealing with day-to-day trading. So you are looking at this move, and then this move, and then another main move, and then the main. So these are the daily trading. However, an application on the investment will be, you look at a big picture. Okay, you look at the big picture. So this could be a few months or a few years kind of a trend, whereby you look at this retracement is the percentage as a percentage of the whole uptrend here. The whole uptrend is how much, and then this retracement, is it 50% or 1/3 of that whole uptrend, so that you want to see that the whole major uptrend is still intact. Okay, so this one is looking at that major macro view. Okay, you can use that for investment purpose. So you can use that for investment purpose, whereby you look at a bigger time frame, 2 years or a few months, okay, for longer time, together with your moving average as well. I will show you 20-day, 200-day moving average. All this you have to put in as well, so that you can see a bigger trend. So basically, when we are looking at the Fibonacci retracement, it could be trading, day-to-day trading, or it could be an overall trend. Okay, then continue. So these are the numbers. You don't have to memorize. I have to say that you don't have to memorize. You just have to look at it as the first one, 236. 236, is it close to 0.25? So 0.25 is 1/4. Okay, then 382, is it very close to 1/3? 0.33. Okay, so that will be 1/3. And then 0.5, half. And 0.618 will be close to 2/3. And this 0.764 is close to 0.75, which is 3/4. So basically, 0.5 is 0.5, right? And this 0.382 plus 0.618 become 1. 0.236 plus 0.764 is equal to 1. So we are looking at like 1/4 plus 3/4 equal to 1, and then 1/3 plus 2/3 is equal to 1. Okay, half and half is half. Okay, so there's no need to memorize so much. You just have to look at roughly. Okay, in the trading, right, I don't really look at very specific, like has to be exactly 0.1, 0.2, that kind of a specific. In very much of my application, right, I look at technical analysis as something rough figure, and then a psychological level, and then a lot of time it's very intuition. So meaning that it will be at one glance at it, you see what is the pattern, and then you have to make a conclusion on that first glance. You get what I mean? So it's very intuition. So if let's say you study the graph for like half a day, you look at it half a day, and then you try to see from in and out, and then from you try to figure out, okay, the more you spend the time on that graph, the more confused you become, because you lose your instinct. So in trading, okay, I do not know whether you believe it or not, very much sometimes depend on your intuition. And this intuition sometimes is just first glance. You look at it first glance, and then that gives you that kind of a intuition. And that is very important. Okay. Okay. Sigma value. Okay, good. Okay, so these are some of the mathematical values as well. Okay, so let's continue. So basically, the retracement can be 1/4, 1/3. So I will usually use 1/4, 1/3, half, 2/3, and 3/4. Okay, so if you want, you can use 618 and 382, because this two will be the most common retracement level. Okay. Okay. Here. So here we are looking at Fibonacci retracement, whereby we call it the pullback. Okay, so just now I already explained the pullback, meaning that it will be the opposite direction of the main trend. So the main trend is a bull trend, uptrend. So the pullback will be this retracement. Okay, and this retracement, you want to see how low it is so that you can buy at the bottom here. Okay, so this now for trading, right? There are two ways. One is that you want to buy at the bottom, so which is this Fibonacci. The other way, you want to buy at the breakout. So that means this breakout will be a level whereby it will be higher than the bottom. So you may not be able to get right at the bottom. So the reason why people want to know about Fibonacci is that they want to know when is the bottom. So in this case, the bottom can be, look at this uptrend, okay, maybe from 1 ringgit to here is 2 ringgit here, okay, from 1 ringgit to 2 ringgit, and then here it retraces 50%. So then here become 1.5. Okay, so the retracement is 50% of the main trend. The main trend, you don't measure using a ruler like slant. Okay, you don't measure like that. You measure the perpendicular height. So meaning that you measure, you do a dot like that, and then you do a dot like that. So you are measuring this height. Okay, you don't measure the slanted height. You measure the vertical height. Okay, so it will be this height from here to here. From, in this case, 1 ringgit to 2 ringgit. So the height is 1 ringgit. So this 1 ringgit divided by 2 is 50 cents. So if let's say you do not want to rely on the software, I teach you the manual calculation, because very often you learn the manual calculation, then your foundation is stronger. If you straight away you use the chart, you rely on the chart, and then you use that Fibonacci, because different software, they will draw differently. Some will draw from left to right, some will draw from right to left. So you will confuse you. So I have to teach you the manual calculation. So the manual calculation will be looking at the height, this height, because you go from here to here, right? So it's 1 ringgit height. And then 50% of that 1 ringgit is 50 cents. So then you minus that 50 cents from this 2 ringgit level. So then become 150 here. So then this retracement is actually at the 150 level. So now let me test you. Can you calculate a retracement at 618? Okay. You use your calculator. You tell me the retracement at 0.618, manual calculation. Somebody gave me the answer already. Okay. I need calculator. So it will be 1 ringgit times 0.618. So it's 0.618 minus away from the 2. It will give me 1.382. 1.382. Yeah, 1.382. So you know how I got 1.382? I use this 0.618 times the height, which is the 1 ringgit. Okay, I use this ratio, the golden ratio, 0.618 times the height, and this height is this height. All right, and this will give me 0.618, right? Then I minus away from the top here. Okay, so it will be 2 minus this one, and this will give me 1.382. So here, if I were to retrace by, yeah, correct. Yes, Patrick, you're right. So if we were to retrace by 612 all the way, we will be here. Will be 1.38. And here at this 618, then you will rebound. Okay. How accurate? Okay, let's see. Okay, so this one is our, okay, I changed to KLCI. So this one, I show you, this one is the, I give you the link. Okay, so this is the tradingview.com. Okay, so the people in the webinar here, you can click on that link and you can straight away go to this chart here. Okay, let's say we are looking at Fibonacci retracement on, remember, just last week we had this retracement, right? It was an uptrend and then followed by this retracement. So now my question is, can anybody tell me what ratio is this? You look at this ratio and then from straight away you tell me agak-agak, like what could be the ratio from here to here and then down here? What could be the ratio here? 2/3. Good. Okay, so let's see. So bottom here and then the top here, and let's see. So, oops. Okay, so the bottom here is here. So we are looking at the price actually crossed below that 618 here for 2 days. And then the third day, it crossed up above that 618. So this particular chart, it has actually overshot the 618. Okay, later I will tell you what's the meaning. Actually, now I reveal it. So when it is overshot this 618, right, it is weak. So if let's say you see another pattern whereby it rebounds from that 1/3 level, let's say this is a 382 1/3 level. Okay, 1/3 level is here. Let's say the chart is like going down here and then rebounds from that 1/3 level and then going up there. Okay, can you tell me this 1/3, is it stronger or weaker than this one? The 1/3 bounce compared to the 2/3 bounce, which one is stronger? 1/3 bounce is stronger? Yes. Okay, yes. Some say weaker. No, it's stronger. Okay, the 1/3 bounce is stronger. Okay, it's not weaker, it's definitely stronger. So if let's say in a normal US stock market, okay, let me show you the normal US stock market. Let's say the S&P 500, and not here, here. S&P 500. Okay. So S&P 500, not this one. Okay, another one. S&P 500, let's say S&P or ETF. Okay. SPDR. ETF. Okay, let's say this one. S&P 500, SPY. Oh, okay. SPY. Okay. All right. So you look at here, and actually we can each of these uptrend, then followed by a retracement, uptrend followed by a retracement. Okay, so we look at this this particular uptrend here. Okay, this particular uptrend here from here to here and then drop here. All right, so let's see from here then to the top here. Okay, and you see what is the retracement. So in this case, it's a 50% of retracement from this leg all the way to up. I don't count the tail, okay? I count the body of the candle. Then here we see that it's a 50% of retracement. Okay, let's find another one. So okay, this from this leg to this here is a full retracement. Okay, so you can actually see that from here to here is actually full retracement. It's actually weakened already. The whole graph here is weakened. And usually whenever you see you want to do a proper chart, right? You must always bring in that the moving average. Okay, so I'm going to bring in the two moving averages here. So the two moving averages, you can guess what are they, right? MA. Okay, so I will click two moving averages. I will use 20 and 200, okay, because I want to see the long-term trend. So I will put a 20 and 200. So here I will put 20, okay. So for index, I usually like to use simple moving average. If let's say technology stock, then you can use the exponential moving average, okay. All right, then the other one, I want to put 200. Okay, now, if you want to see the medium term 50-day also can. So I'm going to zoom out, okay? I'm going to zoom out so that you want to see very far away from a very far away, okay? So here we are looking at this situation, okay? So this 200 is way too far, right? So that is why some of you say 50. Okay, why I use the exponential? Okay, the difference between exponential and simple moving average is that exponential is closer to the original price. So it is very suitable for those fast moving, fast action stock. So if you are looking at a fast action, big jump, big fall, that kind of a stock, you can use an exponential, okay? However, if you are looking for index, slow, heavyweight, blue chip stock, I think simple moving average is pretty good, okay? Yeah, if let's say you're looking for a long term, we can go for a weekly. Okay, let's say I just look at this 1 year or so. So I just use a daily chart. And here I'm looking at this okay, the red line will be the 20-day, and then the green line will be the 200-day. Okay, so I can draw cryptocurrency, right? If you use for Bitcoin, I still use the simple moving average for Bitcoin. Unless you are looking at other coins or other tokens that are very fast moving. Okay, but for the major ones, I still use the simple moving average because I treat that Bitcoin as more like a index, the index of the cryptocurrency. Okay, FCPO, I don't really trade FCPO, but if you want to trade FCPO, I think the exponential maybe is better, okay, because it's also very fast. Okay, usually I'll deal more with the index, okay. So here you see that you have one trend line, okay, and this was the gap down that I mentioned on Monday. It has a gap down, okay, and now it is trying to move towards that. So along here you see a small those up and down. So now you're looking at this major trend. So if there is a big correction here, okay, I'm just saying if nothing confirmed, just saying that if there's a big correction, okay, how low or what's the worst case scenario? By looking at this situation, right, this is pretty big correction. So from here to here, let's see what was the situation. Okay, let's see, we zoom in here. We zoom in here and see. Okay, here let's say because it's all blocked by the volume. Okay, let's say I can see somewhere around there. And this, okay, I'm looking at this correction. So this correction actually is not very deep correction. It's quite a shallow correction. You see, it's only, this is 0.2 something. So it's actually 1/4. So it's 1/4 of the whole up move. So this 1/4 signify very, very strong. Okay, so this beginning of a big downtrend and then followed by this big uptrend, and then you come this major correction followed by this one. So it's still very strong. Okay, now let's say you are looking at this one. Okay, so I zoom out, and then we are looking at this one. Okay, so how bad it will be? Let's say we start from here and then we try to here. So even if it will to give you a 1/4, right, it is only here. Okay, so the whole uptrend for this S&P 500 is still very, very bullish. So I would think that even the worst case scenario, it will be somewhere around there, the worst case scenario lah. Okay, but however, currently we want to observe what is happening this week, and today is a Friday already, so I want to observe what is going to be next week. Okay, and next week will be quite crucial. Okay, not a buy or sell call advice, just some stock move down quite fast, like okay, all this do you put stop loss? Yeah, definitely. Wong, if let's say you're looking for those very, very speculative stock, right, definitely you want to put stop loss, because otherwise, do you want to hold it? Of course you don't want to hold it if it go down, right? We can't short in Malaysia market. How do you get these lines from TradingView? The lines, okay, you go to this indicator, you see the FX. So this FX is the moving average. So you just type moving average and then it will come to you, and then you just click that moving average. Okay, so that is moving average. And this Fibonacci, you click here. In this left hand side, you click this Fibonacci. So here you can choose all this, you see. So I choose the first one, Fibonacci retracement. Okay, and then I start from left to right. So from the bottom to the top there. Okay, so that's how you can do. Okay, so yeah, any time frame. So for example, I'm looking at this one is index, right? So usually index I look at maybe 4-hour time frame, 4-hour or 1 hour. Okay, so this one is a 4-hour time frame. You can always use that also, same thing. Okay, it's the same application. It's just that now the moving average, instead of a daily, become a 4-hourly according to the bar, according to your time frame. So the moving average is according to your time frame. Okay, so it will no longer be a daily, but it's more according to our time frame, which is 4-hourly. Okay, so your moving average will be different. Okay, any difference drawing from top to bottom? You can try. I think the numbers will be upside down. Okay, so if you were to draw from the top to the bottom, I think the numbers are upside down. Okay, let's see. From top to the bottom, yeah, upside down already, so cannot. You wouldn't want to see 100 there. You want to see 0 here, so that you want to see 0.236, 0.382, 0.5, 0.618, you know, like this. Okay, so you have to be here to there. Different software is different. Okay, some software is the other way around. So that is why I want you to learn the manual. If you know the manual, right, you don't have to be, you know, rely on all this chart. You rely on your own calculators. Okay. Okay, continue. So here we are at uptrend, downtrend. Downtrend is looking at this retracement, then followed by a sell. So you want to see how deep is the retracement here. Okay. Okay, another one I want to talk about is this swing high and swing low. How do you know when do you see a swing high or swing low? So if you to look at a chart like this, swing high is usually when you see a top, and then swing low is a bottom. Okay, let me zoom in a little bit, and then let's show some KLCI, or let's show For education purpose, not for recommendation. Okay, front can. I have to put a disclaimer. So this one, you look at it. Swing high, swing low, how do you recognize? So swing high will be up here, up here. So these are the swing high. Usually I don't look at the tail, I look at the body. I look at the candlestick body, don't look at the tail. Okay, because the tail are the extreme. Then the swing low will be here. So I have swing low here, swing low here, swing low, swing low, swing low, swing high, swing high. Okay. In Elliott wave, they said that there is a theory of alternation. Later I'll come into that alteration. Oh no, today not Elliott wave, sorry. My next webinar, Busa webinar, will be on Elliott wave. Okay, then I will talk about alteration. All right. Then only we talk about it. Okay, so hold on to your question. You join us next lesson. Do you take the tail or just candle body? I take the candle body. Okay, because the tail are the extreme, so I don't take that. Okay, so here I'm looking at swing high, swing high, swing low, swing low. So the concept of swing high and swing low is very, very important because these are all the turning points, and which you'll be looking at it for your cut loss and your profit target. Okay, so for example, you are already here. Let's say you are at the historical high. So if you are at the historical high, then there is no previous swing high for you. Then you will probably have to look for a projection. Okay, can you share the link? Yeah, sure. Then our organizer sure will share the link. Okay, I think it will be on October 13. October 13. Okay. Okay, why do some trader uses 2 Fibonacci to look for support and resistance? Okay, that is purely their preference. Okay, I really do not know why they need 2 Fibonacci to look at. In fact, for me, most of my chart, right, I use my own calculation. I don't even use the Fibonacci to draw the over there. I use my calculation, so my chart is very clean. So if you bring in too many things, for example, the Fibonacci is very messy. So if you bring one Fibonacci, it's already very crowded. And then you bring another Fibonacci, isn't it too crowded? So I do not like to crowd my chart so much because it's you want to see a very clear chart. Fibonacci extension, although in this webinar, we do not have time to talk about that Fibonacci extension, but the concept is that it's the same concept. So you are looking at for example, you are looking at this high here, okay, and this one is surpassing here. So you want to see whether you are looking at, when you look to the left, you can't see the swing high. When you look to the left, it's a historical data, right? So you want to see where is your target price. So usually will be the swing high will be your target price. But in this case, you are already at the historical high. So there's no swing high. Then you have to look at the extension, Fibonacci extension. And that Fibonacci extension is looking at from this leg, okay, which is looking at this as 100% here. So you down, okay, so you are looking at this from here all the way down, and then you go back up to this level, okay, all the way up here. Okay, so from here down to here and then up to this level, so you are back to this square 0 here. So therefore your extension, you have to look at this leg here, okay, extension of how long. So if it's 1.618, then you just use this leg here times 1.618, and then this will give you that target over there. Okay, so it will be manual calculation. I will not use that, okay, purely manual calculation so that you know the fundamental. So it will be this leg here, and then you times 1.618, and then that will give you the target. Or you can times 1.382 as well. Okay, so any Fibonacci number will do, or just times 1.5 will do. Okay, so that is the kind of a extension that you are looking at. There is a recording because this webinar, yeah, all these are in the live chat channel, YouTube channel, live chat YouTube channel. Okay, all the videos, webinar, all recorded. It will be in the live chat webinar channel, YouTube channel. Okay. What's the difference if I pull the Fibonacci from the bottom or from the top? From the bottom, okay, you are looking at the Fibonacci from here, is it? Okay, so because that see, I can see a lot of people are confusing because of the pulling of this one, whether you pull from here top to the bottom or from bottom to the top there, right? So that is why I asked you to learn the manual calculation. You see, because it's different software, they will have different orientation. So in this case, you want to pull from, for example, okay, you are looking at this uptrend, okay? And when you are looking at the uptrend, then you have a retracement here. So with this small retracement, right, you want to see how deep is this retracement. So then you measure from here to here, okay? What is the height from here, bottom here to here, what is the height? And then you calculate what is this as a percentage of this height here. Is it 1/3 or is it 2/3? So then if you want to use this Fibonacci, you just put it here and then put to the top here. The tail, I can't see clearly the tail, but more or less is there, okay? So I just put it there. And here is the retracement. So then you can see that this retracement is about 1/3, 0.382, okay? 1/3 of it. So from this bottom to the top, then you can see that the top becomes 0. So when the top becomes 0, then it is correct, okay? However, if let's say you are in a downtrend, then you are not looking at bottom to top. You are actually looking at the downtrend. You are looking from here to here. Okay, so let's see. Here and here. Okay, from top to bottom now. If you are in a downtrend. If you are in a downtrend, you start from the top and then you connect to the bottom. And then this retracement here will tell you where is the strength, okay, the retracement strength. So here you are looking at the retracement strength is around 618, okay, it's about 2/3. So here is about 2/3, and then it come down again, and then before it go up again. So here the retracement is 0.618. Okay, so so do you understand? So for an uptrend, we measure from bottom to top. If you were to use this charting for a downtrend, we are measuring from top to the bottom. Okay, but if let's say you don't want to use all this, you just measure the height and then measure this as a proportion. Downtrend also, you measure the height of this top and the bottom, measure the height, and then you measure this as a proportion. As simple as that. Okay, continue. So quickly we will continue, and okay, so this retracement here up to a point, then we will later then we will talk about how many percent of retracement is considered strong, okay, later. So here we are looking at buy, okay, because you are looking at retracement, and then here is a you know, a breakout. So we can draw one line and then breakout, then buy. Then here also is a downtrend. Okay, so this is downtrend, and then this one is a temporary rally. Okay, because this downtrend is longer. Because when it is a bear market, right, you keep on having a down. In a bull market, you probably will have 10 up days followed by 5 down days. Okay, that means you have more up days than down days in a bull market. But in a bear market, it is very easy to spot whether it is a bear market. If you see that the market has been down for 8 consecutive days or 10 consecutive days, or even sometimes 10 down days, in the middle they have one small up day, but majority are down days. So you have looking at 10 down days and then followed by 5 up days. Then obviously this one is a downtrend. Okay, so here we see that this one you can draw a trend line here, then this one is breaking down. Okay, so you sell short. Okay. The moving average is actually for you to see the overall trend, because sometimes when you want to buy, okay, let's say you are looking at buy opportunity, right? So you see, oh, I see that there is a 50% retracement and then going up. I'm very happy, I want to buy. but then you didn't pull out your moving average, and then suddenly up to a point, then immediately it reverses. Why? Because there is a 20-day moving average is around the corner here that you didn't see and you didn't bring it out. Okay, so that is why I have to see that my chart is clear of the moving average. I don't want to see any resistance line here. 20-day, 50-day, 200-day, all these are moving average. So I don't want to see. So if you happen to see a breakout and then followed by this, these are not good trade. Okay, no, not the chances of success, although is there, but then not high. So I would think that definitely you want to bring out your moving average. Okay, so that you do not want to see any resistance here. Okay, back to the question of 5 to 10 days. Looking in a bigger time frame, it will be different story, or only apply in small structure. Same thing. In a small time frame, also the same thing. If let's say you're looking at a 15-minute chart, 5-minute chart, the number of candlesticks also tell you the bearish or bullish. Same. Okay, but it's just that the bigger time frame is more important, so we call it significant. So usually when you want to trade, why do you think a lot of people, they have so many screens? Like they have like 4 or 5 screens, because one screen is for smaller time frame, like a 5-minute chart, and then another screen is for a 15-minute chart, another screen is for 4 hours chart, another screen is for maybe a daily chart. So you want to have a different time frame, so because you want to look at what is the macro view first. So before you trade, because when you are trading, you are looking at a very small place, you are looking at a very small scale. So before you trade, you want to see what is the big picture first. Okay, you want to see what is it, the big picture. Then only is it overall bullish or bearish first. Then only you choose what you want to do. Are you going to, in a big bull trend, are you going to short? Or in a big bull trend, you're going to long? Okay, so that kind of a thing. Okay. Correct. So moving average line can be a resistance or a support as well. Correct. So this moving average, if it's below here, then it becomes the support. Okay, then you are very happy. Then there's no more resistance here, no more lines here. Then you can buy. Okay, and that target price will be your swing high here, and your target loss will be your swing low. In this case, your swing low, if it's too far, you look for support line. So if there is any support line here, you can use that as your stop loss as well. Okay, so I repeat, target price is equal to swing high or moving average line, MA line, or any support or resistance line. Okay, trend line. And your stop loss is equal to swing low, and then followed by moving average line, if you see, or any support and resistance trend line. Okay, so you are looking at all these target price, cut loss price, and things like that, and looking at the swing high and swing low, and all these are like, you know, when you are driving, isn't it, you have to keep on looking at the side mirrors, and then the front, the mirror, okay, and also the 3 mirrors, and then also looking at always looking out for a situation on the road. So in your trading, you have to do that as well. Okay, always look out for resistance and support line, because you want to see if there is anything blocking you or not, and anything prevent this thing from going up or not. Okay, so all this you have to look out for. Why use the 4 hour? Because 4 hour means half day. 1 day you have 2 candle. Okay, so it's also clearer as well. So you can use the 4 hour to replace your daily chart if you want for trading. Okay, so they can see a macro view. Okay. exit strategy. So this is what I mentioned just now, whereby I am looking at the swing high and the swing low for the stop loss and also the target profit. Okay. Okay. So let's continue. So the support here will be looking at that. If let's say you can put a swing low, this is a swing low, all right? So if let's say you buy here, maybe you can put here as a swing low, as a cut loss. So it'll be slightly below that swing low there, okay, slightly below. And here will be swing high. So your stop loss is here when you want to short sell. So it will be slightly above it. Okay, since this is a swing low and then slightly above it. Okay, now comes to that retracement. Okay, I'm answering Wong's question. So the Fibonacci numbers in technical analysis, right, are commonly used. And as I said, the retracement tells you the strength of it, okay, the strength of it. So another person asked me, use the average true range as a stop loss. Okay, some people, they use that, but for me, I don't use it because average true range, it does give you the volatility for that past 3 days or the past 14 days. So you can see for the past few days, what is the price that we will go, like from what price, or is it very volatile or is it not volatile? So you can use the average true range if you want. But for me, usually I don't use the average true range, okay? Okay, so now back to here. So we are looking at the retracement. And this retracement, if let's say it's 1/4 of retracement, compared to another retracement, which is 1/3, another retracement is 50%, half, and another retracement is 2/3. Okay, which one is the strongest? A, B, C, or D? By now you should know, right? Okay. I still see okay. So I think all of you are there. Oh, some give me okay. So actually the answer is A, because you just understand the psychology. The psychology is very simple. When you are in the uptrend, right? And then when the retracement is only a little bit, and then suddenly everybody rush in and buy already. So people didn't wait for much retracement, and then they will rush in and buy. So this kind of fear of losing mentality, you get what I mean? It's like, I just drop a little bit, but then everybody will rush in. Okay, so this one, maybe I want to show you, okay, not recommendation for education purpose. Okay, so this, is that how you spell Gintech? Okay. So this so this Gintech, you look at it. So every retracement here is a very brief retracement. It's like everybody is like fear of losing out, you see. So it retraces a little bit, everybody rush in and buy. Retrace a little bit, everybody rush in and buy. So the psychology, what does this psychology tell you? So this psychology tells you that a brief retracement indicates the trend is still very, very strong. Understand? If let's say you see another one, okay, maybe this one, okay, Astro. So you see that Astro is having a correction, and this correction at one time you saw that it's supported by the 200-day moving average, and it is like trying to recover, but now it is below that 200-day moving average. Okay, so this kind of a retracement where it is going deeper and deeper, right, is weaker and weaker. Okay, so whenever you see that retracement getting deeper and deeper, it is weaker and weaker. So in the end, you probably will have to measure the height, and then you want to see whether this one is within that 50% of retracement. If you can still see within 50% of a retracement, then it is still okay. Okay. However, if it go down to 60% or more than that, it is very, very weak. Okay. Okay. Let's go back. Okay. Opcom. Okay. No, later when we have time, then we will look at all those charts. Okay. Then you look at it now. So you see this 23.6, 38.2, 50%, and 618. So in the end, which numbers I will probably like to see, okay? I would like to see this 50%. So whenever the 50%, right, you want to see that within 50%, it has to rebound. I wouldn't want to see that it go below that 50%, okay? So within 50%, I want to see a rebound. So otherwise, I would think that it is very, very weak. So even though if you were to rebound at the 618, I would treat you as a very weak sign, okay? So if let's say a chart giving you 1/3 of a retracement, I would think that it is quite okay, quite healthy, quite normal. So anything within 1/3 retracement, okay. 50% in question. 61.8 or 2/3, no good, not a good sign. Okay, so these are the things that you need to remember, and this one probably you need to memorize a little bit because this one has to go together with the Fibonacci. Okay, do you apply Fibonacci to investing? Yes, we can do that also. We can do that for a longer term trend. Okay, so you can look at maybe a longer term, maybe 5 years or something, and then you look at that longer term trend. So for example, you can see that so this one is Astro. So Astro, for a longer term trend, you can look at this longer time frame, because if let's say you are looking for investing, right? So then you can see that at around 50%, maybe if it drop around 50%, maybe I can accumulate. So you use the word accumulate, and then you may not want to use the word cut loss, because this one is dividend stock. You want to hold and then to collect the dividends. So you can either come buy at around 50% of Fibonacci retracement, or you can wait. I do not know whether it will go, I don't think it will go down to 61.8, but more to the 50% is possible, okay, or somewhere around there. So it's possible. Okay, so you can use that for investment as well. Okay. So Hang Seng Index, yes, can later. Okay. Okay, case study. So here Fibonacci, we are looking at the retracement. So here is a diagram. It's a very clear diagram whereby this one is MI. Okay, MI, you are looking at from here all the way up. So this was last year bottom. Okay, so you usually you can start from a bottom. You can choose one bottom. If let's say you want to see a bigger picture, you can start from a major bottom. If let's say you just go for day-to-day trade, you just look at your immediate bottom will do. Okay, so here we are looking at this bottom here, and then the top will be that this 1.5 years kind of a top there. Then you see this retracement. So recently in May, it has actually crossed below that 50%, but it didn't cross to that 618. But overall, it's still very, very weak, because the minute you cross beyond that 50%, you are considered weak. Okay, the minute you cross beyond 50%. So let's take a look. And we can use that for Nasdaq as well. Okay, wait now. So let's look at this Fibonacci with RSI. Okay, how can we use it together with the RSI? Now, one application of the RSI to me, I think, is looking at the accumulation. If let's say you have a certain stock that you like, you have a watch list of a stock that you like, and you know that this watch list of a stock, they are on an uptrend, and then you want to buy whenever they are oversold. So then you can use this RSI together with the Fibonacci, because whenever it is oversold, then you know that there is a retracement. So then you can buy at the retracement there. Okay, so here you see that the Fibonacci is showing a retracement for up to 618. Okay, and then for the RSI is also oversold here. So then here you can confirm, and then you can buy as well. So usually for RSI, it is good for applying into an uptrend. So it could be a technology stock. It could be a dividend stock. Okay, so as long as the stock that you want to accumulate for long term, you can do that. Because every time when you buy at the oversold, right, then you can sell on the next day or the next few days or next few weeks. You can sell. You don't have to wait until that overbought here. Okay, so it is you can do that as a form of trading as well. And you can do that for investment as well. So if let's say you buy at the low point here and then you just want to buy and keep, you can do that. Then you just buy and keep. And if let's say you want to do for trading, you can do as well, because this is oversold. So whenever oversold, then the price will have a quick rebound. And this quick rebound, usually you can profit easily. Okay. RSI accurate. Well, it is more accurate when you are on the uptrend or horizontal. But if you are on a downtrend, I'm afraid you will be buying lower and lower and lower. Because if you are on a downtrend, every time when you have a RSI, for example, I show you Tanaga, let's say. Tanaga. So let's say downtrend here, Tanaga downtrend here, right? From last year onwards, all the way down. And then we bring out one RSI here. So actually from here, you can see buying opportunity. You can see some buying opportunity here, some buying opportunity here. Because you are in a downtrend, so you probably are buying lower. So you see here it's oversold, right? So you buy. But here, how much is it? It's 11.24. And then the trend keep going down because it's a big downtrend from last year to actually is from 2019, from 2019 all the way to last year. Okay, so it was a big downtrend. So here you also see some oversold here, and then you buy. But if you are below the 200-day moving average, right, that means you are in a big downtrend. You are below that 200-day moving average in a big downtrend. So when you are in a big downtrend, you probably will buy, and then you see that you get trapped because you buy at 12. Here is 14. Then you get trapped. Here is you buy again. Here is 12, and then you trap again. And then here is 11, and then you get trapped again. And then here it's you are buying all the way down. Okay, 10, and then you get trapped. And until finally 9 something, then you are not trapped. But the cost is actually quite high already. So you get what I mean? So RSI is not good for a downtrend. So it is good for either a horizontal or uptrend. And for the moving average is not good for horizontal trend. So it is only good for trending, either you are uptrend or downtrend. So different indicators, right? You must know what is their strength and weakness. Then you can apply correctly. So the indicators is not simply for all the chart, you simply apply all the indicators. No, I don't do that. I only put a very simple, clean chart with a 20-day, 200-day, and some basic trend line, a very, very clean chart. And then I see what I need. So if let's say I want to buy, accumulate some good stock, then probably I will bring out RSI. Okay, so you must know what you want first, then you bring out the relevant indicator. Okay, you don't put everything into that chart. So it's very, very messy, and then it will confuse you. Definitely will confuse you. So the objective is that you must learn how to draw a trend line. In the end, what matters is not how much Fibonacci knowledge that you know, or how much Elliott wave knowledge that you know, or how much sophisticated indicators that you know. In the end, it is very simple. Okay, I show you. Let's say front can. Okay, so this front can, let's say you are looking at this trend here. Okay, so let's say you want to trade, okay, and then you want to make money in the stock market. And in fact, it is very simple. You look at this trend line, buy low, and then buy at the breakout here, and then you sell, okay? And you buy again here, and then you sell. And then you buy again here, buy low, and you sell here. Okay, then you can buy here. Here probably you will it's a horizontal trend. So you sell here, and you either you break even or you make very little money. Okay, but sometimes in a horizontal trend you may lose money. Okay, in a horizontal trend, but in a prevailing trend probably you make money. Okay, so you just simple if you can do this, draw trend line in 1 second. Like, you know, you draw trend line without how you draw trend line. Some people, okay, if you can draw trend line like very fast, like 1 second, you can decide 1 second, within 1 second. So that means you are very familiar already. So when the minute you are very familiar, you are able to see things, and then you are probably able to trade with your intuition. Okay, you can do that. So that means that you are acting like a robot, very much as a robot, and then you just perform your transaction only. You don't have much emotion involved. So this is the best way, whereby you are using your intuition to trade. You see, you're using your intuition to trade, and then no hard emotion, no regret, no happy, no sad. You are basically trading like you are a robot, and then you know, you just buy and sell accordingly. So if I lose money, I just cut loss. If I make money, and then I see the trend line break, and I just take profit, and that's it. So I am not emotional at all. So if one day you can do this, you can draw your trend line so fast and without hesitation, and then you can trade comfortably without being stressful, because we have two thinking. Okay, one is a fast thinking and one is a slow thinking. So this one is by Professor Daniel Kahneman. Our thinking has two systems: fast thinking and slow thinking system. So the slow thinking system is the one that is very conscious. Like, for example, the first time you learn how to drive, it's very conscious. The first time you learn how to play badminton, the first time you learn how to skate, you are very conscious, and then you always do mistake. Okay, so that is very conscious. And once you master the skill, right, then you can perform driving with your subconsciousness, and then you can perform badminton with your subconsciousness, and you can play skating. Ice skating is very relaxed and carefree and subconsciousness. So can we on one day we can turn this trading into our subconsciousness? So meaning that we can perform without having to think too much, and then it is more comfortable, and then stress-free, and then the performance is better. Because when you are very conscious, maybe you think too much. For example, you look at this situation. I zoom in a little bit. Okay, so for example, in this situation, right, you are supposed to buy. Okay, there's a breakout. Okay, you're supposed to buy. Then you probably will hesitate. Okay, so you said, oh, I don't know whether this thing will go down. It's too near the 200-day moving average, and then there's this 20-day moving average I haven't passed, and it's too near the 200-day moving average. What if I buy and then it go down, and then what will happen? So you have a lot of this kind of what if. Okay, so when the minute you have all this what if and what if, you are being hesitated, and then you are being emotional. So once you are emotional, right, then you are not being objective. So then you can't make a good decision. So if let's say you are like a robot, you just follow the instruction. The instruction is to trade at the breaking out trade. So you just buy, sell, buy, and then now you are still holding it. Okay, so you buy, you sell, and then you buy, and then you sell. So you are not being affected. You have no second thought, no second guess. Okay, so that is by intuition. So if one day you can do that, I think the results could be better. I'm not sure. I think could be better. Okay, for me, I'm trying. I'm now trying to do this, and I already see some results if I'm using this. That means I use more relaxed way of trading. That means I don't trade on a very small time frame. I trade on a bigger time frame. So this time frame is maybe I will hold for a few months, and then I use daily chart. Okay, so I look at the big trend. So I don't look at the small 15-minute chart. So because if you are looking at the small time frame, right? Small time frame, the prices is too volatile, and it could be very emotional to you. And especially if you are looking at the chart on a daily basis, because if you are looking at the chart on a daily basis, you will not expect yourself to be tip-top condition. When you are like a sportsman, you need to have a certain condition, then you can perform, right? So when you are in this trading or investment, okay, especially trading, because investment is a different mindset. In this trading business, you are actually looking at your performance, and your performance depend on your condition. So you can't expect every day you happen to be in a tip-top condition, clear mind, and then precise, and no emotional, because we are human, and then we always come with these emotions. And sometimes this emotion is without you realizing it. And you may feel that, oh, these few days I'm not very feel very good, and then I feel lethargic, and I feel moody, and things like that. Sometimes you do not know what's the reason, and it could be due to the environment, it could be due to the sentiment, or psychologically, whatever, and that will definitely affect your investment or your trading. Okay, so that is why if you try not to look at the chart on a daily basis, you look at it more in a casual way. You look at it like as if you are looking at 2 days one time, or every week, or whatever. So you are able to see some instinct, you are able to show some intuition out of it. Okay, like first glance, what is that intuition that give you? So this kind of intuition is hard to come by, but then you can train. Okay, the more you practice, the more you will get it. Okay, so okay, somebody say you want to see the Hang Seng Index, HSI. Okay, the problem with the HSI is this 4-year chart pattern here. Okay, let me show you a 4-year chart pattern. Okay, so here you see that this one is a chart pattern there, right? It's like a top, it's a double top, it's a multi-top chart pattern. So we can straight away draw a top is here, and then the neckline is somewhere here. So the chart is quite weak. Okay, it's very weak here. So we are looking at this neckline here, and then this is going to a lower low, because you are this is a low, and then you are getting to a lower low. So you are looking at this big chart formation. I hope it won't break. Okay, let's show the it is already below that 200-day moving average. This one is a daily chart. Okay, let me put a daily chart here. Okay, put a daily chart. Okay, so this is a daily chart. So we are already below that 200-day daily chart. So if you want, you can show a weekly chart. Okay, see whether it is still above or below that weekly chart. It is also below that weekly chart. So it means what? It means that it's very weak. Okay, and let's go back to that daily chart. And we want to see what happened in here. Okay, so from far, then you zoom in and then you see what is happening here. So then you see that this one is getting a lower low. So here you have a lower low. Okay, so when you have a lower low, that means you are in a downtrend. So you can draw trend line, and you can draw a trend line here. This is also a chart pattern. Okay, this is also a chart pattern whereby it has violated. You can measure the target. What is the target? Actually, I saw the target already met around here. The target already met here, which is here. Okay, the target already met here. So at one point, you may think that, oh, the target met already, so there's a rebound. But in the end, you are coming into this double top here. So the minute you see a double top and then you are in a downtrend, you are likely to see that it will fall. Okay, so you have to measure this is the height. So this is the height, and then what is the height you measure, and that will be the target. So the target is around there. So most likely it probably will be volatile a little bit here. So this is for the Hang Seng Index. Okay, and that is because of the news happening, right, for that the property developer company. But most likely, I think it will be privatized or state-owned. In the end, all this will be built up by the government and it becomes state-owned. So usually it's like that. Okay.
You may want to wrap out your session on Fibonacci.
Oh, yeah. Sorry, I forgot.
10 o'clock already.
Okay. So here we are looking at the yes. So we are looking at the risk to reward ratio. So it will be 3 times. So we are looking at risk is 1 and then reward is 3. So when you have the like a double top and then you see there is a breakout, so you are looking at short. Okay, so let's say we go for a going up, okay, and then going for a positive breakout. Okay, so when a positive breakout, you are looking for long, and then let's say there's no moving average in front, but then there is this previous high, so you need to see what is the previous high there. Okay, and if this previous high is allow you measure the height of the target here. Okay, what is the target here? The previous high, and then you look at the previous low. What is the target here? And the previous low will be your cut loss. So if let's say you are here and then you see what is that previous low, right? The swing low. So this you measure is this, and looking at this level, this is this 1/3? This cut loss, is it 1/3 of the whole thing? Okay, so if let's say it is 1, because let's say this is like a 10 cent, and then your target is 30 cents. Okay, so your cut loss is 10 cents and then your target is 30 cents, then you have a 3-to-1 risk reward ratio. However, if let's say you cut loss at 10 cents and then your target is also 10 cents, then you are looking at 1-to-1, and that is not a good trade. Okay, so you must see at least 2.5 and above. I will look at that. Okay, the risk to reward ratio. Okay. Okay, thank you, Dan. Okay. So great sharing. Okay, thank you. So that is actually the last slide for this one. Okay. So I hope today's session you learned something, and because sometimes I forgot about the timing. So I hope and I have answered most of the questions, because as I'm delivering, I also look at that chat questions in the chat as well. Okay.
Yeah, thank you, Pauline, for doing this a very engaging session as you answer Q&A on the chat group along the way. So we did not do the Q&A at the end.
Yeah, that's
okay.
Right.
So that will let me share my slide. So that will conclude today's session on Fibonacci trading, on Fibonacci analysis on trading. So thank you so much, Pauline, for sharing with us your trading strategies using Fibonacci. I think we have all learned a lot. So thank you for spending your precious evening with us. I know that you are very busy lately. Okay, so but still thank you for gracing our event with your knowledge on this Fibonacci analysis. All right.
Okay, thank you. So I see a lot of thank you. So thank you so much. Okay, bye-bye.
All All right, so let me tell you more about our next webinar. Okay, our next webinar is on the title, A Winning Formula to Profit from Stocks on Bursa Malaysia. That's happening on next Wednesday, which is from 8:30 to 10 o'clock. So let me give you the link again to register for our next webinar. Already registered. Awesome. Okay, so today we have two webinars to tell you about. One is the Pauline next session on Elliott Wave, and then the other one is this, which is on next Wednesday. So Pauline's session will be on 13th of October. So you may block your calendar for the next session with Pauline on Elliott Wave. But in the meantime, next Wednesday, if you can't wait until Elliott Wave session, next Wednesday, we have this, A Winning Formula to Profit from Stocks on Bursa Malaysia, where the emphasis is also on TA. Okay, so it's happening on 29th September. So that will be the last webinar for the month of September. So remember to register yourself. All right. So thank you so much, Pauline, for joining us in this Bursa webinar, Fibonacci Analysis for Trading. Hope that all of you here have learned have gained enormous value from this session. So have a pleasant rest of the day, guys. So have a good weekend as well. Okay. Bye, everybody.
Okay. Bye.
See you on next Wednesday.
Okay. Good night.